Ever wondered how bonds work? Well, you're in the right place. Let's kick things off by understanding what bonds are. Imagine lending some money to a friend with the promise that they'll pay you back with a bit of interest. That's essentially what a bond is, but on a much larger scale. Entities like governments or corporations issue bonds to raise money. These are then bought by investors, who in return receive interest payments during the life of the bond and the initial amount back when the bond matures. Bonds are a crucial part of the financial world. They offer a way for governments to fund public projects and corporations to finance their growth. Furthermore, they provide investors with a means to earn income while preserving their capital. So in a nutshell, bonds are essentially IOUs, issued by entities like governments or corporations. There are various types of bonds you can invest in. Let's start with government bonds, sometimes called sovereign bonds. These are issued by a national government and are often considered the safest type of bond because they're backed by the full faith and credit of a country. Next, we have corporate bonds. Companies issue these to raise money for various purposes, like funding operations or expansion. These bonds usually offer higher yields, but they also carry more risk because companies can default on their payments. Then there are municipal bonds, or munis. These are issued by cities, states, or other local entities to fund public projects. They often have tax-free interest, making them attractive to certain investors. Lastly, savings bonds are a type of government bond typically purchased by individuals. They're low risk and often used for long-term savings goals. Each type of bond comes with its own set of characteristics and risk levels. Let's dive into how bonds actually work. Picture bonds as an IOU between you and the entity issuing the bond. When you buy a bond, you're lending your money to the issuer, be it a corporation or government. In return, they promise to pay back the face value of the bond, also known as the principal, on a predetermined date, called the maturity date. Now the sweet part is that while you wait for the maturity date, the bond issuer will pay you interest, commonly referred to as the coupon rate. This is usually a fixed percentage of the face value, paid out periodically until the bond matures. Here's a simple example. Let's say you buy a bond with a face value of $1,000 and a coupon rate of 5%, payable annually. Each year you'll receive $50, that's 5% of $1,000 until the bond matures. So when you buy a bond, you're essentially lending money to the issuer for a defined period. Understanding bond terminology is key to making informed investment decisions. So let's start with the term yield. Yield refers to the return on your investment, expressed as a percentage of the bond's face value. It takes into account both the bond's interest payments and any gain or loss in the bond's price. Next, we have principal. This is the amount of money you initially invest in a bond. It's also the amount you'll receive back when the bond reaches its maturity date. Then we have coupon payments. These are the periodic interest payments you receive from the bond issuer. The rate of these payments is known as the coupon rate. Lastly, let's discuss bond ratings. These are ratings given by credit rating agencies that assess the creditworthiness of the bond issuer. The higher the rating, the lower the perceived risk of the issuer defaulting on their payments. These terms help you assess the potential return and risk of a bond. Bonds can offer several advantages to investors. Let's start with income generation. When you invest in bonds, you're essentially lending money to the issuer, be it a government entity or a corporation. In return, the issuer promises to pay you a predetermined rate of interest over a specified period. These interest payments, also known as coupon payments, can provide a reliable source of income, making bonds an attractive option for those looking to supplement their income. Now let's talk about risk. Compared to stocks, bonds are generally considered less risky. Why? Because bondholders have a higher claim on the issuer's assets and income than shareholders. If a company goes bankrupt, bondholders are usually first in line to be paid. It's like having a VIP ticket at a concert. However, it's important to remember that while bonds can offer lower risk, they don't eliminate it altogether. Every investment carries some degree of risk. Bonds can provide a steady income stream and add stability to your investment portfolio. However, like all investments, bonds come with certain risks. One of these is interest rate risk. This is the danger that if interest rates rise, the price of your bonds will fall. Why? Well, because new bonds will be issued with higher coupon rates, making your old bonds less attractive to buyers. Then there's credit risk. This is the chance that the entity issuing the bond might default, failing to make payments as promised. This risk is more prevalent in corporate bonds than government bonds, as companies are more prone to financial instability. So, how can you mitigate these risks? To manage interest rate risk, consider shorter-term bonds. They're less sensitive to interest rate fluctuations. As for credit risk, diversify your bond investments across different sectors and credit ratings. Remember, no investment is risk-free. Always consider your risk tolerance and investment goals before investing in bonds. So, how can you buy bonds? Now that we've covered what bonds are and how they work, you might be wondering how to get your hands on them. Well, there are two main ways to buy bonds. First, you can use a brokerage account. Think of it as your gateway to the bond market. Most major brokerage firms provide access to a variety of bonds, including government, corporate, and municipal bonds. Second, you can buy bonds directly from the issuer. For instance, you can buy US Treasury bonds directly from the US Department of the Treasury's website. Whether you choose to buy through a brokerage or directly, the process is pretty straightforward. You'll need to decide how much you want to invest, which bond you want to buy, and when you want it to mature. Remember, always do your research before buying a bond. It's crucial to understand your investment and the risks involved. The bond market plays a significant role in the global economy. It's a vast, intricate network where borrowers and lenders meet. Borrowers, such as governments and corporations, issue bonds to raise capital. Lenders, or investors like you and me, buy these bonds with the expectation of a return on our investment. Did you know the bond market is colossal, even larger than the stock market? The global bond market is estimated to be worth over $100 trillion. That's trillion with a T. This behemoth of a market impacts everything from interest rates to economic growth. Bonds also offer a temperature check on the health of an economy. When uncertainties loom, investors often turn to bonds, particularly government bonds, as a safe haven. On the flip side, a thriving bond market may signal a healthy, growing economy. Understanding the bond market can help you make informed investment decisions. It's a fascinating world, and we're just scratching the surface. Let's summarize what we've learned today. Bonds are a crucial part of the financial world, coming in various forms like government, corporate, municipal, and savings bonds. They function through key elements like face value, coupon rate, and maturity date. We've learned essential bond terminology such as yield, principal, coupon payments, and bond ratings. Bonds offer benefits like income generation and a lower risk compared to stocks, yet they also come with potential risks like interest rate and credit risk. We've discussed how you can mitigate these risks. We've explored the process of buying bonds and gave an overview of the bond market's size and significance. We've also talked about how you can incorporate bonds into your investment portfolio. For a deeper dive, I recommend checking out resources like Investopedia, the US Securities and Exchange Commission's website, and financial news outlets like Bloomberg and the Financial Times. Remember, investing in bonds is a long-term game. Patience and research are key. We hope you found this video helpful. If you did, and you're keen to continue your journey into the world of bonds, do subscribe to our channel. Give us a thumbs up if you've learned something new today, and don't hesitate to share this video with others who might find it useful. Got a question or a thought to share? Drop a comment below. We'd love to hear from you. Stay tuned for more educational videos on finance and investing. Until next time.